Most people think this sequence breaks even. Start with $100, gain 10%, and you have 110. Lose 10%, and intuition says you are back to where you started. But that intuition is wrong. You end at $99. Not 100. You are down 1%, even though the arithmetic average of plus 10 and minus 10 is 0. That gap is the hook for this entire episode. Volatility drag is the silent tax created by an imperfect path. It is not a rounding error. It is the mathematics of compounding itself, and it affects every portfolio, every market, and every holding period. Here is the core math. One period up by r and the next period down by r gives a geometric factor equal to the square root of 1 minus r squared. As long as r is greater than 0, that expression is less than 1. Plug in 10%, and the 2-year path becomes a small but real loss. This is why the geometric result, the result your money actually experiences, sits below the arithmetic average whenever there is volatility. In continuous approximation form, geometric return is roughly arithmetic return minus sigma squared over 2. That sigma squared term is the drag. It matters because it scales quadratically. Double volatility, and the drag becomes 4 times larger. That is the number investors consistently underestimate when they talk about average returns. Now, look at what quadratic scaling means in practice. At 5% annual volatility, drag is almost negligible. At 10%, it is still manageable. By 15% and 20%, the cost becomes meaningful. Around 20% annual volatility, the drag is roughly 2% per year. At 40% volatility, the drag jumps to roughly 8% per year. At 80% volatility, the drag explodes toward 32% per year. That means a very volatile asset has to earn more than 32% on average just to offset the mathematical penalty created by the path. The point is not that all volatility is bad. The point is that volatility has a hidden cost, and the cost rises far faster than intuition suggests. This is not just theory. Historical S&P 500 data from 1928 through 2025 fits the approximation remarkably well. The arithmetic average annual return is about 11.85%. Annual volatility is about 19.4%. Apply the formula and you get a predicted geometric return near 9.97%. The realized compound annual growth rate lands around 10.02%. On a century scale, the approximation gets very close. The implication is important. Even a broad diversified equity index pays a volatility tax over time. If you compare a smooth 11.85% world with the actual realized compound path, the long-run difference in terminal wealth becomes enormous. Volatility drag is not only a crypto story or a leveraged ETF story, it is present even in the core equity market benchmark. Volatility drag has a second face, loss asymmetry. Once capital falls, the gain required to recover rises non-linearly. A 10% loss needs an 11.1% gain. A 20% loss needs 25%. A 50% drawdown needs 100%. A 75% drawdown needs 300%. This is why avoiding large losses is mathematically powerful, not just psychologically comforting. Recovery time compounds the pain. If a portfolio falls by half, even a 10% average annual return can require more than 7 years to recover. At lower return rates, the wait becomes much longer. The lesson is simple. Large drawdowns do not just hurt in the moment. They permanently raise the hurdle your portfolio must clear to get back to even. Compare 3 very different paths. Short-term treasury bills have low volatility, so the arithmetic and geometric returns sit close together. The drag is tiny. The S&P 500 has far more volatility, so the gap between arithmetic return and realized compound growth becomes clearly visible. Then look at an 80% volatility example, a level common in highly speculative markets. The arithmetic story can look exciting, but the geometric outcome collapses because the volatility term eats such a large fraction of the average return. This is why investors should never quote arithmetic averages in isolation. The number you care about is the return that survives compounding after the path has done its damage. Low volatility assets, broad equity indices, and high volatility assets live in very different drag regimes. Volatility drag cannot be eliminated, but it can be reduced. The first lever is lower volatility. Smaller swings mean a smaller sigma squared term, though the trade-off is often a lower arithmetic return. The second lever is diversification. When you combine assets that do not move together, the portfolio path becomes smoother than the weighted average of the components. That can reduce drag without cutting expected return, 1 for 1. The third lever is systematic rebalancing. Rebalancing trims relative winners and adds to relative laggards, which can tighten the path and harvest some variance over time. There are limitations, too. The sigma squared over 2 rule is an approximation, not a law of nature. In fat-tailed or highly path-dependent markets, realized drag can be worse than the simple formula implies, but directionally, the principle remains robust. Here is the clean recap. Plus 10% followed by minus 10% is not 0. The drag term is sigma squared over 2. Historical market data supports the approximation. Losses are asymmetric, which is why recovery is so hard after deep drawdowns. And the way to reduce drag is to improve the path through lower volatility, diversification, and rebalancing. Final disclaimer. This video is for educational purposes only and does not constitute investment advice or a recommendation to buy, sell, or hold any asset. The volatility drag formula used here is an approximation. Historical return figures are based on long-run market data, and high volatility examples are illustrative. Past performance does not guarantee future results. Always do your own research and consult a qualified financial professional before making investment decisions.